Hello, and thanks for joining us today. So what I'm going to cover today is where do we fit in Camissa, and why would we be a good fit for your client solution? We have been materially delivering in terms of alpha over 21 years and counting. And I think importantly, we as the team, the core of our team who've delivered this 21 years of alpha, of outperformance, are still together and still resident in our company. Breaking it into 12-month periods, the 12-month rolling alpha, so every single year that one can look at on a monthly basis for 21 years looks as follows. So 67%, 2/3 of the time over 1-year periods, we've been ahead of benchmark. And I think one of the points I made earlier was just that with a truly active manager who has skill, there will be times of disappointment. So there will be 1-year periods, 1-year patches that one's got to guide a client through a period where we slightly underperform. That's the price one pays for long-term outperformance. But looking at 5-year rolling periods, every single 5-year period that we've delivered over 21 years, there you can see that 86% of the time we have been ahead of benchmark. 86% of 5-year periods we've been ahead of benchmark. In other words, ahead of the average manager in this context. Now that's truly evidence of long-term skill. So as a highly active, skilled manager, what is on offer? We have a focused fund range. We try and do a small number of things really well. We do a low risk fund, our stable fund, medium risk, our protector fund, targeting inflation beating returns, our balanced funds in a global version and an SA version, targeting the maximum return given Regulation 28 constraints. And then finally, our highest risk funds are true active equity funds with an equity alpha fund. There's the track record I showed you just now, which has a bit of a global element to it as well. And then an SA equity version, and then our global equity fund is also available. Looking at their track records in turn, and just looking at equity alpha balanced and stable, I'm not going to necessarily go through every single number here, but you can see substantial returns delivered over 1, 3, 5, 10 years and since inception. But looking at the quartiles at the top, mostly first quartile, with 1 or 2 shorter term periods and other periods that we've just slipped out of top quartile into the second quartile. Substantial skill. That skill has been rewarded by many awards over the years, and this just shows you the last 7 years or so and a couple of awards that we've won. And again, I'm not going to go through them in too much detail. So I would put forward that we are truly different in terms of what we offer to clients, and truly are fitting the bill in terms of what your clients need. We're an independent investment firm with 77.6 billion Rand in assets under management. Around about a third of that is retail or unit trusts, and that's our fastest growing area. We are a true high conviction active manager, as I've shown, very differentiated relative to where the bulk of clients in this market sit. We're a large, stable investment team with lengthy experience together. The core of our team, as I said, owns our track record. We are valuation focused. In other words, we very much care about the price we pay for any asset that goes into your clients' portfolios. We have a contrarian orientation in that we often are looking at areas of the market or particular situations or stocks or securities where there is pessimism, crowded pessimism, and that's more than reflected in prices, and therefore you get a very good deal. And trying to avoid crowded optimism, where often that's the highest risk, where the herd is flocking towards good news and prices well over discount the prospects that are reasonably and practically going to be delivered from the popular stocks. And we are generalists by nature. We're the third best SA equity manager since inception, since 2004. And if you look at just the SA only category, that's the second best. We've delivered 15.3% per annum returns net of fees over these 21 years and continuing to grow that track record. So where does our current high active share currently lie? And looking, in other words, drilling into our portfolios very briefly. And I want to show you that it lies not just in the equity side, which is a key part of most of the portfolios, but it also lies in the asset allocation and the fixed income security selection. So in terms of asset allocation, I've broken our global balanced fund into a pie chart here just to show you that we are more overweight and higher weighted in global equities than local. So 39% global, 31% local. In terms of locally listed stocks, we are biased at the moment away from South Africa's focused companies, given our very low growth profile that lies ahead for South Africa and the pricing of those shares. And we are tending towards local equities, as I'll show you in a second, that just happen to be listed here but earn the bulk of their revenue offshore, earnings offshore. We have a big hedge, put option hedge in place within the portfolios to protect in these volatile times to the downside. And then on the fixed income side, mostly sitting in government bonds. So we are wary of the pricing in corporate credit instruments, and also the fact that these instruments are coming down in yield as interest rates decline, but are quite in favor of the very high yields that are on offer in the government bond market, both at the shorter end as well as at the very long end. Drilling into domestic equities, what is it that we hold? Our significant holdings and where we derive a big part of our active share is in the platinum sector, PGM sector. Valterra Platinum is the new name for Amplats, Northam. Then in the diversified minings, Glencore, which is coal and copper and other things. Exxaro is coal and iron ore. Omnia. Then on the industrials front, a wide variety of businesses, but on the larger front, Prosus and Naspers, big position, our biggest position. And then MTN is a big industrial position. That's one that actually most of the large managers could own, but actually, if one looks at the portfolios, doesn't make many top 10 holdings. So very contrarian, very high active share positioning. And then on the financials front, very counter to what the consensus is doing, where we're getting a lot of active shares, not having much in the terms of banks and insurers, but tending towards one or two of the asset management type businesses like Quilter in the UK, which is a wealth business, which is pretty much nothing to do with South Africa, and we think has great growth prospects going forward. So very different positioning in terms of looking at some of our larger positions. And then where our active share also derives from is having zero weights and a wide variety of other stocks, which would be anchor tenants in many of the larger manager and other manager portfolios. So first up on the resources front, no gold, which is, I think, very counterintuitive at this point in time in terms of holdings at a very volatile and supposedly risky time in the world, with lots of geopolitics weighing on people's minds. None of the largest diversified miners, BHP and Anglos, zero. And then on the large industrials front, none of the large, very popular consumer staple businesses like British American Tobacco and AB InBev, the brewing company, and then zero in Bidcorp, also a very popular South African holding, and then zero in Richemont, the global luxury goods business. And then finally, some of South Africa's best businesses, doing the best, where I would argue the reason we don't hold any of them zero in Capitec and Shoprite is because there is such crowded enthusiasm and crowded optimism about their long-term prospects. Their prospects at the moment and what they're delivering is superb, and I almost couldn't make any single criticism of them other than their share prices are just a little bit too high. And so a wide variety of our active share derives from zero weights in a number of these very popular stocks. In global equities, our big active share derives from the fact that we have a very large underweight positioning to the US. The US markets, as many of you will know, makes up well north of 2/3 of global equity markets, and we have pretty much half that in terms of weighting. We take that active share and deploy it in overweights in Europe, often in multinational European companies which have nothing or very little to do with the European economy, which is looking pretty low growth, but actually are multinationals which service the rest of the world and are very lowly rated or much lower rated because they happen to be in Europe. And then overweights in Japan, which is some very interesting dynamics unfolding as inflation returns to their economy and their corporate governance standards in Japan improve materially in the years ahead. And then drilling into sectoral positioning, here I've just drawn out a couple of the large positionings that we have. So in the consumer discretionary front, some names there that don't necessarily make many of the popular funds out there, Dollar General and JD Sports. Dollar General is a value retailer in the US. JD Sports is a athleisure, mostly sneakers retailer in the UK. Both of them have seen substantial share price falls of late, and they're high quality businesses which we think are very pessimistically priced at the moment. Then on the healthcare front, a key theme for us in our portfolios, and here we are in the pharmaceuticals in something like Bayer, and then in medical equipment that supplies hospitals in a company like Philips. On the financials front, which interestingly has been one of the best performing sectors over the last 5 years in global markets, which is quite a counterintuitive thing to say. And I think most people wouldn't have picked it as the top performing sector over the last 5 years. We've got some Japanese banks, Sumitomo and Mitsui, and then Prudential is a life insurer, or the insurer that services Asia in particular, and services and sells to many fast-growing economies in that part of the world. On the industrials front, we have Daikin here and Siemens. Daikin is air conditioning, and in a global world that's warming, you'd expect that an air conditioning, the leading air conditioning manufacturer in the world, would be quite highly priced, but actually at the moment it's reasonably lowly priced for a variety of reasons. Siemens is a German conglomerate, one of those multinationals I spoke about earlier, which has a wide variety of very interesting future-focused businesses, like software automation business that if it was listed anywhere else in the world would be very, very, very highly priced. And so another, I think, a key anchor tenant within our portfolios. And then finally on some other stocks, some household names like Walt Disney and JD.com is like the Amazon of China, one of the Amazons of China. And then Applied Materials is a key manufacturer of components and machinery that's used in the making of semiconductors, which is a very fast-growing area of the world at the moment. Drilling into fixed income, or what we call yield assets, I'd position that discussion with just putting up the South African government bond yield curve. And here you can see all the major government bonds that one has available, with their yields on the y-axis and their term to maturity in years on the x-axis. And you can see a very high yield curve, so substantial yields that are available to you for sort of 10, 15 years out, and well above 11% guaranteed by the government coming at you as a fixed deposit for 10, 15 years. And where we positioned is predominantly in the 2040 area, the 15-year area, and then as opposed to holding anything floating rate or cash or corporate credit, we're getting 9% guaranteed by the government for the next 5 years in the sort of 213 area of the curve. Now, that's what you will get if the yield curve doesn't move. Now, if the yield curve does move downwards, as we expect it should, because these yields are really, really high, where could it get to? Well, that's up there is where we think it should be, where it should trade. And that pink line is where we think the yield curve should be. And incidentally, that's where it was around about 5 years ago. So if the yield curve does move down there, you get an extra 22% from the 2040 to the 15-year area, extra 22% capital gain. Now, you don't need for it to move for you to get a good return. You still get your 11%. But you get that 11% per year for 15 years, plus a capital gain of 22% there. And then if, as the Reserve Bank is strongly suggesting, we move our inflation target down to 3%, we'd argue that pink line moves down a further 1 to 1.5%, and you'll get an additional 14% capital gain from the 2040 to 15-year region, as well as an additional 6% capital gain at the 2 and 3, the 5-year region. So that's the major rationale for our, I think, very contrarian, very high active share fixed income positioning in virtually no cash, virtually no floating rate notes, virtually no corporate credit, and mostly government bonds. Thank you very much for your attention.